Well, hello and welcome to the second trading day of December. We're seeing the bulls kicking off December with a gain. That was yesterday to close at the equities market. We'll see if that gives a pointer to what to expect. Maybe we get that Santa rally this December and make up for the loss that we see in November. Let's get to the top stories that set your agenda now. Starting with the oil market, we're seeing oil prices little change today from that big move up saw yesterday. But Brent still trying to hold on to that $70 level. $71.97 traded this morning, 0.19% up. The U.S. grade, WTI, $68.18 a barrel. That's up 0.12% this morning. So we'll find out what to expect for the oil market later on this week. To the FX market now, we'll see trading there unchanged for the NFM window, 1,672. That was the close. So we still see the Naira closing within a tight range there. Hitting the resistance and support levels back to back. NAFEX, that's down 0.57% to close yesterday. So not much to report there. We're still seeing the Naira there oscillating within that range. To other stories now, the Abia State Governor, Dr. Alex Oti, has urged investors and business owners to return to Aba, the commercial capital, assuring them that issues that forced them to leave have been addressed. Speaking at the opening of a 10-day international trade fair at the Aba Mega Mall, the governor highlights the city's market's potential, skilled workforce, and growth opportunities. Dr. Oti says his administration has improved road infrastructure, security, and waste management to restore Aba's lost glory. Take a listen.
It's on. The state is proud to host you and shall provide you with every necessary support to make your participation at the 2024 Aba International Trade Fair an unforgettable experience. This trade fair and our active involvement is a recognition of the fact that Aba has so much to contribute to our country's economic aspirations, whether it is economic diversification, job creation, or driving higher volume of national output. Another equally important reason for getting involved was to announce the return of Aba as a major industrial and commercial destination in the West African region.
At a high-profile event held at JP Morgan's London office, the federal government has successfully raised $2.2 billion in the Eurobonds with an order book exceeding $9 billion, making it significantly oversubscribed. The central bank governor, Dr. Yemi Cardoso, and Director General of the Debt Management Office, Patience Onia, were present, highlighting the strong investor appetite driven by confidence in Nigeria's economic reforms. Take a listen.
You recall a couple of weeks ago, the National Assembly did approve the issuance of up to $2.2 billion in international capital markets by Nigeria. So today we've been in the heart of London at the offices of JP Morgan, one of our financial advisors, alongside Citibank, Goldman Sachs, and Standard Chartered Bank, as well as the homegrown Nigerian Chapel Hill Denham, all financial advisors, for us to raise $2.2 billion in the international capital markets. The outcome of this exercise is that we approached the market early this morning. The notices went out to all the fund managers around the world that we are looking for $2.2 billion. By just after 4 o'clock this afternoon, the orders, the demand had come in at $9.2 billion. So that is 4 times oversubscribed and more.
So there you have it. The allotment, $700 million for the 6.5-year bond. That's priced at 9.625%, and a larger $1.5 billion for the 10-year bond. That was priced at 10.37%. Well, join us now to analyze. We have Mr. Egie Akpata. He's the chairman, Skymark Partners. Joining me via Zoom. Great to have you on the show. Good morning.
Good morning.
So there you have it. We finally tapped the Eurobond market after a 2-year high test. How are you seeing this?
Well, I think it was a successful outing. I think in terms of the pricing, I think the 6.5-year instrument, I mean, technically priced below where the secondary market should have been. So I think they got very good pricing, and by just opening a bit earlier than we thought, they managed to just catch the market unawares, or at least get into the market when there was liquidity, and it was a very successful outing.
And, we've seen the U.S. Fed, cut rates in the previous meetings. And there's that risk that rates might start rising again at some point. And we've seen, most of the preferred gauges for the U.S. Fed, we've seen not coming out, according to expectations. So if inflation starts rising again, in the U.S., what is the risk to us tapping the Eurobond market again?
Well, I mean, these bonds are fixed rate bonds. So at least for the one that has been issued, irrespective of the direction of interest rates, the rates the Nigerian government will be paying are fixed. In terms of future, I think almost every projection is for the Fed funds rates to be lower in 12 months from where it is now. The question is whether the bond market moves in the same direction. I mean, since the last Fed rate cut, I mean, the 10-year Treasury in the U.S. has moved probably about 60 basis points higher. So there's a bit of a difference between the short-term Fed funds rates and the longer-term bond market yields, which is where these instruments are issued, and which is what really matters.
And there you have it, oversubscribed to the tune of $9 billion. Why do you think investors are always so keen on Nigerian bonds?
Well, I think there are a number of reasons why they are keen. One is in terms of the absolute price. I mean, Nigerian government has never issued a bond with a coupon above 10%. Prior to now, the highest was 9.25%. So when you see over 10% from a credible issuer, you're very interested in buying that instrument. Also, the Nigerian government has never defaulted in the bond market, and there's no expectation that will happen anytime in the foreseeable future. That is reflected in where Nigerian Eurobonds are trading. So again, a large issuer, large transactions attract large investors globally, a credible issuer who has a very good track record and a relatively attractive price on an absolute level. But on a relative basis, the spread between this issue and prior issuances is probably less, about 6.2% above the 10-year Treasury if you do the 10-year to 10-year comparison. So the investors like what they saw, and they put their money down.
Right, and putting your money down, looking at the 10-year bond there, that's priced at 10.375%. So what are the implications, for you of this high yield rates for this 10-year bond? And what is it saying about Nigeria's financial stability?
Well, I mean, it says that Nigeria is bankable. I mean, not every country in Africa can go into the market and raise large sums. There are quite a number of countries who the market wouldn't touch because of defaults and other macro and fiscal issues they have. So I think that's a positive. I mean, it's probably not likely that we'll see this kind of above 10 rates again from a Nigerian issuance because given the direction of travel of rates, they'll probably try and avoid this in the future. But again, you have to work with where the market is, and they had to pay up.
Right, and definitely 10%. That seems quite expensive.
Yeah, I mean, again, the prices are relative. There's really nothing like any absolute price. I mean, the 10-year Treasury in the U.S. was 1% a bit over 3 years ago, maybe almost 4 years ago. Now it's 4.2. So it's almost 4 times what it used to be. So again, rates move. Everything is relative to other benchmarks. And relative to the benchmarks, this pricing is somewhat competitive. Rates have moved up globally. It's not a Nigeria-specific issue.
So how do you think, the government should use these funds? We see it's to cover the shortfall for the deficit in the 2024 budget. How are you seeing, that spend, with this money, and how is it going to impact the Naira, the short term?
Well, I think in terms of the short-term impact on the Naira, bear in mind that these bond transactions they're probably the most flexible kind of foreign currency borrowing
the Nigerian government could do. So by next week, there'll be $2.2 billion just paid into the government's accounts, and they can do what they want with it. So what that does is a couple of things. It boosts reserves. So you'll probably see CBN reserves start to creep up. They report a moving average, 30-day average basis. By end of the month, the reserves will be over 42 billion. So that gives a bit of confidence to people transacting in the foreign exchange market that there are reserves in the CBN to somewhat intervene in the market. And that is definitely a positive for the Naira exchange rate. It's a bit different from when reserves were much lower or dropping. So when reserves are rising, it gives confidence that the currency at least.
Right. So, we're seeing this current raise at this time. Is it the right move, going into 2025 to, stay Naira-denominated assets?
Well, that's a very tricky one. I mean, when you bear in mind that the last T-bill auction, the one-year yield on one-year T-bill was 30.7%. Now, 30.7 on 1 year. I mean, if you bought a 1 year Eurobond, Nigeria Eurobond maturing November next year, maybe you're getting about 6-7%. So would you rather get 6-7% in dollars or 30.7 in Naira? Right now, given where the exchange rate is, most people will probably bet that 30% means the Naira has to go probably over 2,000, and they'd rather just stay in Naira instruments. So Naira instruments are looking a lot more attractive now than at any time in the past few years.
All right, let's look at the stock market performance now for November. We'll see about 0.1. That's for the all-share index in the month of November. How did you see that performance, and what are you expecting for this December?
Well, I think statistically 0.1 is almost insignificant. I mean, so I wouldn't put much emphasis on it. But I think what it does, though, is it does give people who haven't positioned themselves into the market enough time to get in. You normally have a bit of a rally, from December up till dividend time in March, April. So it gives people a bit of time to get in if they pick the right names that are probably showing good growth in earnings and prospective dividends looking attractive.
Right, and 2024 is winding down at this point. I'm sure some investors are trying to make that informed decision on where to pile cash into in 2025. What are you seeing?
Well, it depends on your time horizon and your risk preference and what kind of mandates you have. But clearly, I mean, if the one-year Treasury bill remains at this kind of level, that is probably one of the most attractive plays you can get. If you're getting 30% risk-free, that's not a bad starting point. In terms of the equity market, the high dividend paying companies and high growth companies, because you need earnings growth and dividend growth to kind of support share price appreciation. Those will be attractive, which mainly mean upstream oil and gas and banking stocks. Those will be a good place to go into, at least in the early part of next year. Again, things can change, and it's very important to be nimble. On the dollar side, again, 10% in dollars per annum is always attractive, and it might make sense to have some exposure in that area.
We know the central bank governor over the weekend, he did hint at rate cuts coming in 2025. He didn't say that categorically, but there was a hint there. We know how central bank governors, investors take those hints, seriously. So let's imagine the rate cuts start coming, in 2025. Do you think the banking stocks are still where to pile cash into?
Well, I mean, in last year's bankers' dinner, he did say rates will stop rising in the second half of this year, and that didn't happen. So I think there are a number of variables out of his control, like the level of federal government spending, fiscal deficits, and a couple of other inflationary things that mean that rates might not move in the direction as projected. However, if rates do start to fall, then probably the best place to be is in Naira bonds, because those bond prices will appreciate as rates are falling. In terms of the equity market, on the short term, I'm not sure that falling rates will have much negative impact on bank earnings. But yes, over time, if you start to have, then it's possible that their net interest margins start to compress. But it wouldn't change the trajectory for next year, even if rates started to fall later next year.
All right, we'll definitely be monitoring all of that movement. But thank you so much. It was great having your perspective, Mr. Ege Akpata. He's the chairman, Skymark Partners. Thank you so much for coming on today.
Thank you, Larry.
We'll take a break now. When we come back, we'll look at the latest PMI reading for Nigeria. That's in a moment. Just stay with us. Welcome back. Well, data from Stanbic IPTC shows that Nigeria's Purchasing Managers Index, which is a key economic indicator that measures the health of the manufacturing and services sector, so the index remained below the 50 points range in November. Well, join us now. We have Dumebi Oluwole to unpack this for us. Great to have you.
Hi,
Dumebi. So, yeah, it's another PMI. And we're still seeing that below 50 points, contraction.
Yeah, I mean, it's clear as to why this is happening. We do know some of the issues that both manufacturing sector and a lot of, services sector activities are facing, like trade. So basically what this just tells us, because the Stanbic IPTC PMI primarily tracks activities along the small to medium scale businesses, right? So while it also tracks some level of large scale business activities, primarily you find that a lot of the businesses that are, covered in that index are not exactly like large as like multinationals, basically. That's what I mean. And you find that these businesses right now are facing a lot of issues with like logistics cost, high operating expenses. The exchange rate is doing its number on their operating cost as well. And you find that weak consumer demand is also a very big issue for them, affecting their ability to move their products. And when you break down the index, you see that they're having issues with output, they're having issues with stocking inventory, that's new orders. You also find that there are issues with the current inventory that they have, like selling that as well, their stocks of purchases, right? So they're having issues selling what they have. They're having issues also, getting new stock of purchases or new orders. And then you find that there's also some issue with employment, because if businesses are not able to produce enough to sell or expand their operations, their ability to absorb labor is also thinned out. And we're also seeing that issue, with the numbers are also telling us that's an issue that businesses are also facing right now. So that's pretty much what is happening. But I think one thing to also note is that PMI is a forward-looking indicator to GDP growth, right? So if PMI numbers are contracting consistently, because now this is going to be the 5th consecutive month of contraction. And what this is telling us is that there will be certain shocks to GDP growth from the supply side of the economy. Especially if we're going into, when we'll start looking into, 2025, that typical lull in GDP growth where we see at the first quarter will be much more, it will be intensified when we look at the lag effect, or the spillover effects rather, from what is happening of 5 months prior leading up to that point.
Right. So what is it telling us about Q4 GDP? Because we did see growth for the third quarter.
Third quarter, yes.
So with this PMI, already showing this direction.
Yeah, I would say that to an extent, there's some divergence between what the PMI numbers are saying and what the actual GDP numbers have actually shown. Because if you see, this is the 5th month of contraction, yet we saw an increase in growth in the
services sector,
and the services sector was still
drove
although some of the sectors within the services sector were responsible for the growth that we saw. So if you dissect the Q3 GDP numbers, you realize that financial services and telecoms, financial services and insurance and telecoms actually contributed almost 60% of the growth that we experienced in Q3 2024. And what that tells you is that growth is not broad-based, right? Still somewhat emphasizing the point that we're seeing here, right? If we're seeing the manufacturing sector, that's industrial sector, slow. We're seeing agricultural sector activity slow. We're seeing trade activity slow. And those are the job elastic sectors of the economy. And they actually contribute a lot more in terms of consumption and supply. So we're seeing sectors like that slowing their activities. What that tells us is that right now, growth is not broad-based in the economy, and the trickle-down effect that we should be seeing from GDP growth into economic development, into better living standards, we're not going to see that right now.
Right, and we also see Nigeria raising about $2.2 billion for its latest Eurobond auction. So it seems that this government is getting really liquid.
This is the hot topic now.
Point.
I mean, this is good news, and I say it's good news in the sense that we're seeing oversubscription, like very strong oversubscription on the loan, on the issuance. And what that tells us is that, to an extent, right, we're seeing that businesses or investors rather are encouraged to bring in money into the economy based off of the reforms that we've taken. Now, government actually leveraging the momentum that is receiving right now, because when you put this 2.2 billion side by side our current deficit from the budget, it's still not sufficient, right? Our deficit in dollar terms right now about 9-point-something trillion. When you convert it to dollars, it's about 6 trillion. Sorry,
right.
And this is not even up to that. So what it still tells us is that there's still some revenue deficit or still funding deficit that the government still has to plug to substantially meet up with the 2025 budget, right, that it has in proposal. And aside from that, there's also the momentum side of things, where this money that we've gotten, there's a huge expectation now from investors that the money is spent appropriately to ensure that what is being spent on, there's a positive multiplier effect on the economy, right? Ensuring that we do not spend this $2.2 billion on recurrent expenditure, but actually spending it on sectors that will be able to, ensure that, number one, there's broad-based productivity, and number two, we see an increase in consumption levels.
And hopefully not infrastructure that we don't really need.
Exactly. So if we're gonna, so here it is. In times like this, the government has to definitely prioritize its spending, right? So even if you want to spend money on capex that we do need right now, that will be able to support productivity from businesses to increase outputs, and then ensure that prices are bid down, and there was beginning to see that positive loop in the economy where businesses are actually producing as much, they're able to now export, because in times like this where the naira has significantly lost value, if businesses are able to produce as much, that's where the positive aspect of exporting comes in, and they're able to generate more in naira terms. But if businesses are struggling to produce because there are issues, infrastructural issues that are affecting their ability to be productive, then we'll continually see the issues that we're facing. So while this is good news, there has to still be that government has to definitely leverage the momentum that it has received from investors to do the right thing.
Right, and 9 times oversubscribed.
Yes.
Yeah, you see the minister there.
Extremely excited.
Extremely excited.
I saw the
showing that investors are keen. On this bond, but we still have that issue, that 10-year. I think you're bond about 10%.
Exactly. Again, you can't really blame investors, because we're still living in a high interest rate environment, both globally and right now. The only thing now is that there is, looking into 2025, there is the expectation that it is very possible that the rate could somewhat decline going for when it's time to actually repay, simply because we're going into a world where interest rates might start declining a lot more fast.
And I heard it's fixed.
Yes, it is fixed, but again, investors are still going to be able to trade the bonds and stuff. So while the main interest rate is fixed, if we're going into a world where interest rates begin to fall, what it means is that while the coupon rate is fixed, and we're going to actually pay that amount, subsequent debts that debt service burden on Nigeria would not be as much if the global interest rate environment declines. And remember, we're looking at a 10-year time frame. What are we? There's no fixed movement on borrowings. What if the government still decides to borrow, going into 2031 or 2034? Those conversations might still happen.
How close is Nigeria to its debt ceiling?
I mean, I would say we're still pretty much in a safe space in terms of the government's debt ceiling. But when you look at what the IMF has recommended for developing economies, which is about 55%, you see Nigeria is getting pretty close to that. Right now, current debt service, when you add the $1.5 billion loan that we got from the World Bank, and if you do add this $2.2 billion loan, $2.2 billion Eurobond, you realize that we're actually going above 50% right now. And what that means is that we're getting close to that 55% threshold. And what it means is that while there is this momentum, sovereign credit rating agencies will still be on the lookout for how Nigeria is able to be productive, again, with the revenue that they have gotten, to ensure that our debt is actually sustainable, and we're actually able to repay the debt that we currently have, and as the Eurobond maturities, come up.
All right, let's look at the oil market now. From a over 3% drop last week, this start the week, on the front foot. But what is playing out really in that market? We've seen the Hezbollah-Israel ceasefire. Rising.
I mean, I would say right now there's a lot of market sentiment around the Trump administration and also interest rates, and the U.S. Fed not actually reducing interest rates as fast as the markets would have expected. So some of those are actually impacting the oil market. I think one thing to note on the effect of the Trump administration or Trump coming in is that there are expectations that if Trump comes in, the US dollar is going to strengthen, right? And that those market sentiments are already feeding into global commodity prices. And that's one of the reasons why we're seeing, crude oil prices trend higher. And primarily, there's still also sentiments around OPEC's conservatism on actually increasing its supply. So the cartel had actually planned to increase supply going into 2025. They were going to not reverse their supply costs, but at least ensure that their member countries are able to ramp up supply. But considering how prices have been quite volatile, trending lower, but I think it hit about $70 per barrel sometime last week. And then we're also seeing like fears of lower demand and stuff coming up. So the cartel is quite conservative, and that is also priced into the global oil market right now.
Right. All right. I guess we'll keep watching and see if we have a positive outing for the oil market this week. That's good for government revenue.
Exactly.
At the end of
exactly.
All right. Thank you so much, Dumebi Oluwole. I was giving us all those details there for most of these markets that we track. All righty then. So let's get a check on what's playing out in the equities market. That was for yesterday. We did see the market starting off in the green. Yes, December kicking off there. It's a marginal gain, 0.05%, 97,733. That's for the all-share index. The kickoff for the December trade. Let's look at the trading activity. So it's mostly muted. It just deals in the green, 23.50%, 9,329 deals. More compared to last Friday's trade, but volume and value on the low side. Let's look at the sectoral performance that we see was all green for most of the sectors that we track, just industrial goods unchanged. In banking and insurance, financial services, 0.08 marginal gain for the banking counter, and the insurance with a more convincing 0.22% uptake. Oil and gas, 0.10%, and consumer goods, almost second, leading pack. Top trades, Japan Gold, UBA, Access Score, top trades yesterday. So definitely eyes on these stocks for today. Let's see how investors react to this second trading day of December. But thanks so much for watching. I'm Lade Williams. I hand things over to the Sunrise Daily team.